Good afternoon, everyone. We're just waiting for people to join. All right, we'll get started. Welcome to the Lockheed Martin Retirement Maximization webinar.
How not to miss out on what you're entitled to and get every last penny you can get before your retirement clock.
And you know you have one.
Show zero. Okay.
Before we get started, let me share with you some quick disclaimers. This is not meant as tax or legal advice, so please talk to your licensed professionals before taking any action. And a little bit about our firm. We are Strittmatter Wealth Management Group. We're a registered investment advisor, been around since 2007. We are certified financial planners and fiduciaries. We specialize in retirement planning, investment management, estate planning, real estate investing, and then we specialize in working with Lockheed employees. We've been working with Lockheed employees for over 20 years now, and we know the benefits inside and out, and so that's what this presentation is for. And we are a team practice, so there are 3 advisors. I am Josh Strittmatter.
I'm Kelly Boofink.
And then Corey's not joining us today, but we work together to provide financial planning services to our clients.
And so we have a lot to cover today, Josh. So let's take a look at our course outline for today. We have 6 key important areas we'll talk about. First will be the recent changes, which are not so recent anymore. Then we'll talk about your pension, how it works, and the specific strategies you can use. We'll also talk about the ins and outs of your 401k and strategies for it as well, your healthcare options upon retirement, your insurance benefits and what you can take with you into retirement. We'll also review the top 10 mistakes to avoid, and then finally, we'll wrap it all up. So let's get started then with changes. All of you are probably well aware of the changes to your pension plan, and that all aspects of it have been frozen. So the pension was closed to new employees starting on January 1st of 2026, and then all of your pay elements under the plan were frozen after December 31st of 2015. Your credited service accruals were frozen as of December 31st of 2019. So there's no further way to increase your pension benefits. Now, the retirement savings program also underwent a change in conjunction with the pension plan changes. As of January 1st of 2020, employees received the automatic 6% contribution into the savings program, which is up from 2% in the past. So if you are funding your 401k with at least 8%, and then Lockheed is contributing the other 6%, you are then getting 10% into your savings. So let's talk about your pension. Josh?
Yeah. So let's first of all define a pension. A pension, also known as a defined benefit plan, provides a specified monthly benefit at retirement to eligible employees once you've reached your vesting schedule. And so Lockheed Martin pension plan uses several variables. We'll go over those variables in just a minute. And you're eligible for your pension benefits once you've reached 5 years of vesting service or when you turn age 65.
And it's important to note specifically for theirs too, unfortunately, it doesn't inflate.
That's right.
Well, let's look at those differences between the contribution plan and a defined benefit plan. So you guys actually have both at Lockheed. So the defined contribution plan is best known as your 401k. So those benefits are based on the amounts that are contributed, plus or minus any income, expenses, gains, or losses. It gives you an individual account that you can see the details of on your statements from Empower. You and your employer can contribute to your account. Again, they contribute 4% if you contribute 8%. And the contributions are based on a percentage of your salary and or to the years of service. And yours is based on a percentage of your salary. So you're responsible for your own investment selections as well. And any dollars withdrawn from the 401k, those are taxed as ordinary income at your regular income brackets if you made pre-tax contributions. Now, if you made post-tax contributions, then only the gains on those contributions will be taxed as ordinary income. Now, for that 401k, there is a mandatory distribution that begins at age 73, and that's based on the IRS Uniform Life Tables. So it's called a required minimum distribution. Now, comparing that to your pension, the benefits are based on a calculation using your years of service, the Social Security breakpoint, the average income, and an accrual rate. So some participants may or may not be required to make contributions depending on the plan. You are not required to make any investment selections. The people behind the scenes make those selections for you on the pension side. And your income from the benefit and retirement will be taxed as ordinary income. And your pension must begin no later than age 73, unless, of course, you're still working.
Yeah, so let's talk about the defined benefit plan advantages and disadvantages. So again, this is your pension. So your employer is responsible for providing the retirement benefit. Employees know the retirement benefit amount in advance. You can use your calculator to determine the amount that you'll receive once you retire, and you can use that for planning purposes. Usually doesn't depend upon your ability to save. So you guys, actually, they save on your behalf. So you don't have to allocate any dollars towards your pension plan. There's no investment risk for participants. So one of the disadvantages to the employer is that they take on all the risk, and that's why many employers have gone away from them. Plan assets are managed by professional money managers, so the plan is managed by investment managers. Others offers tax-deferred retirement savings, so the pension funds go in pre-tax and they grow tax-deferred. And when you pull them out, they're taxed at ordinary income taxes. May offer cost of living adjustments, however, yours does not. So one of the disadvantages of a pension that does not inflate is it does not keep up with inflation. So that's where your other retirement assets would need to step in retirement to help you to offset those increases in expenses. If insured, PBGC guarantees most, if not all, earned benefit if employer cannot afford to pay. And so your benefit's a little bit different in that they pass it on to an insurance company, and then the insurance company provides the guarantees. Disadvantages: no individual accounts are established for the employees. So the only thing that you get is a calculator. May provide only a portion of funds needed for retirement. So it's not meant to be the end all to help you to retire. It needs to be supplemented, in other words. Plan is often difficult for employees to understand. So it's a calculation that we'll go through that's a little complex. But again, mostly you should just get a statement to see what you're going to get. Usually it doesn't benefit employees who leave before retirement. So just like any other pension plan, you have to vest into the plan and then make assumptions of you working there for a long period of time. Benefits are typically not payable until normal retirement age. And so your pension, again, has a 5-year vesting schedule and then payable at the normal retirement age. And you can start it as early as age 60 for most of the employees at Lockheed. Most plans do not permit lump sum payments at retirement. So your plan does not allow a lump sum out of it. It simply provides beneficiaries that can continue that income stream after you've passed away.
Yeah, so let's talk about how that pension is actually calculated. It's based on 4 factors. One is your final average pay. The second is your Social Security breakpoint. The third is the plan accrual rate. And then, of course, fourth is your credited years of service. So go ahead, Josh.
So you have these components broken down. So you have the final average pay. And remember, this was frozen in 2016. So it looks at your top 3 pay amounts. It doesn't have to be consecutive years. And so in this example, the top 3 for this person was in 2011, 2014, and 2015. You total those up to 203,000, and then you divide by 3 to find the average. So 67,666 is what this person's pension would be based off of.
Yep. So that's factor number 1. And then we have factor number 2, which is the Social Security breakpoint. So that is the average of the Social Security maximum wage base, meaning it's the income limit on which you pay Social Security tax. It's an amount they publish every year, and it's indexed or increases each year. So for you, it's based on your birth year, and it's calculated as an average over a 35 period, which ends the last day of the year in which you reach normal retirement age for Social Security. which for most of you will be 66, 66 in some months, or 67. So, and that break point will be based on the table that's in effect when you retire or you quit working. So tell them about factor number 3.
Absolutely. So the accrual rate is the third factor. The accrual rate is the factor applied to your final average pay used to determine your benefit. So it's a multiplied rate. And there's actually two accrual rates for Lockheed. You have an accrual rate for credited service up to 35 years. And it's based on your final average pay up to your Social Security breakpoint. And it's multiplied by 1.25%. Any final average pay in excess of the Social Security breakpoint is multiplied by 1.5%. And then if you have service in excess of 35 years, any pay above that is multiplied by 1.5%.
Yep. And so let's look at an example. It's a little bit easier to see in an example. So in this one, we have a 65-year-old who's retiring with 20 years of credited service. So we'll assume a final average pay of $125,000. The Social Security breakpoint for someone born in 1959 is, let's see, 99,720. So from step 1, we multiply the breakpoint by 1.25%, giving us 1247. Step 2, we multiply the income over the breakpoint by 1.5%, giving us 379. In step 3, we multiply the two amounts below and above the breakpoint by the years of service, giving us an annual benefit of $32,520 a year, or monthly $2710, based on your life only. So no survivor benefit on that. But Josh, you did say there were survivor benefit options.
There
So
are survivorship
tell us
benefits.
about those.
Yeah, absolutely. So that calculation was just for the single life only. And the single life only calculation is what all other calculations are based off of. So your other calculations are joint and survivor. Joint and survivor options provide a beneficiary or survivor a payout for the remainder of their life, and it's based upon the percentage of the owner's payout. So as an example, a joint and survivor, 50% means that the owner is going to get 100%, the survivor would get 50% of what the owner was going to receive. 100% means they both get the same amount at the death of the first person. So a continuation of the payout, and something that's unique to Lockheed is you have a pop-up provision. So when you choose a joint survivor payout, that means you're going to get less money because they're going to have to pay out over 2 lives instead of 1. So the disadvantage of that is that if your survivor dies first, I know that sounds kind of funny, but if your beneficiary dies before you do, you're stuck at a lower payout. What Lockheed does is they have a pop-up provision. A pop-up provision basically takes that lower payout at the death of your beneficiary, and it pops it back up to the single life payout. But it only does that in the first 5 years. So after the 5th year, you'd be stuck at that lower payout.
Right. So before you make these decisions, it's very important to make sure you've evaluated all of your options carefully before you make that election, because once you make that election, you can't go back and change it. So with your joint and survivor payout options, what you're basically doing is purchasing a life insurance policy from your pension plan, because when you die, they're guaranteeing that your pension income continues to your survivor. The risk with that joint survivor options, like you said, Josh, is if that survivor dies before you after year number 6. And at that point, you're locked into that lower monthly pension benefit, exactly like you said. So an alternate strategy is to consider to purchase your own life insurance policy, which may offer better rates, benefits, and enhance the pension annuity option that you select. So Josh, why don't you take them through the example of Bob and Julia?
Yeah, so what Kelly just referred to is called pension maximization. Pension maximization is the idea of trying to get more out of your pension by utilizing a strategy. And that strategy is exactly what you just mentioned. Instead of relying on the pension company to buy the life insurance on your life, you can buy your own life insurance. And in doing so, you take this single life payout. And the difference between the two payouts is what you use to pay for the premium. And essentially, the death benefit that you're seeking to achieve is the joint 100% survivor payout. So it's a present value number of a future annuity. And so I'll get more into that in just a minute. But in this example, Bob's got these two different options. Again, he's got many more, but these are the two that we look at for pension maximization. So the single life payout will pay out $2,875 per month. So again, the single life pays out through the end of his life, and then nothing is paid out to a survivor or a beneficiary. The joint 100% survivor is less. It's $2,010 per month. And that will pay out to the beneficiary and to the owner. So while the owner is alive, $2,010, and then when the owner passes away, the beneficiary would receive $2,010 as well per month. So the difference between those two payouts is $865. That's the amount of money that you don't get when you choose the joint and survivor payout. So what we're seeking to do is to utilize that difference, in this case, the $865, to see if we can get more out of this pension. And so the idea here is that if we can buy life insurance that would pay out $2,010 per month to the beneficiary for the remainder of their life, and I can do it at or below the cost, so in this case, $865, I win. And the reason is, and I'll let Kelly tell you why.
Well, you explained the slide, so that's fantastic, because that's exactly how it works. If Bob did choose that single life option, then he uses that extra income, that $865, just like you said, to buy that policy. And if it costs less, then they've increased the monthly benefit while he's alive. In addition, the policy provides a death benefit. If it's more than $2,010 per month for Julia after Bob dies, then they've come out ahead. So it's exactly what you just said, Josh. What they're looking for is a policy that costs less than $865 and pays more than that $2,010.
Yeah, and Kelly, again, the benefit of this is that if my beneficiary or survivor dies before I do, I can just cancel the life insurance. And then I'm still receiving the single life payout. So I'm getting that higher amount for the rest of my life. I can also just choose to keep that life insurance and change the beneficiary to provide an estate. One of the complaints about the pension is that you pay into this pension, and if both of you and the survivor die, on day one, nothing goes to your beneficiaries. So the idea of having a life insurance policy actually creates an estate that can be passed on to the next generation, if you'd like. If the spouse dies first, obviously that's going to be used to pay out to the spouse, but if they both die around the same time, then that life insurance just provides a way to provide assets for the estate.
Mm-hmm. And, it's really, really, really important. So this is your big warning notice, everybody. You have to look before you leap on this. And this is what I mean, because if Bob and Julia should first find out, one, if Bob qualifies for the life insurance based on his health, along with the cost of the policy. Bob should buy that policy first, make sure it's in place, it's been paid for, it's issued, it's all done before making that final pension decision. Because if you don't, if they made the decision first and then applied for the life insurance policy, he could potentially not be insurable, meaning he cannot get the insurance. And now they're just locked into that decision that they made. So Julia might just be up a creek without a paddle if there is no survivor pension to rely on in future years. So you have to be very, very careful. So Josh, walk us through the details of this example if we are going to actually use this pension maximization strategy for Bob and Julia.
Yeah, so folks, I'm going to show you the calculation of how this is done. And essentially what we're trying to define here is how much life insurance needs to be purchased to replace the pension. And so here are our different variables. So we're looking at the age of the person and their spouse. So they're both age 60. Wants to retire at age 65. And then we look at life expectancy. So the owner of the pension, his life expectancy is age 89. The spouse is 90. So the single pension payout is $2,875. The joint pension, 100% survivor, is $2,010 per month. No cost of living adjustment. And so the difference between those is $865 per month, as we already talked about. So the lump sum required to replace that 2,010 per month, so that would pay out to the spouse's age 90, is 322,000. Let's see,
171.
171. Yep. And then the future value of the savings is 510,000, and we'll show you more about that in just a minute. So the next slide will show you kind of this breakdown of these different death benefit or lump sum required. So column 4 there, it shows you the lump sum required to replace the pension. It starts at 322,000. And notice that it starts to go down as the owner gets older. So in the last year of life, what's needed is only $23,000. And the reason for that is that as you get closer to your life expectancy, obviously you're going to need less money because you're closer to the end of your life. So pay attention to a couple numbers here. The first number is 322,000, so that's how much I would need to purchase today. But also look at the year 20 number, because we're going to talk about another strategy. Notice it's 121,833. So Kelly, move us forward one more slide, please. And I'll let you explain that one.
Yeah, because there's a couple ways to put this strategy into place. So one is by using cash value or permanent life insurance. And it's permanent because it's designed to last your whole entire life until death or until cancellation. So this is the recommended type because the insurance will not expire prior to your death. A term policy by itself is not a good solution because it may expire prior to death as well. The second strategy is actually using a combination of both that term and the permanent insurance because it may allow you to pay less overall in premiums than if you purchase that permanent cash value policy by itself. So when you use these in combination, both that 20-year term policy and a permanent life insurance policy, the calculations are based on those numbers that Josh was just talking about. So Josh, go back to your numbers.
Yeah, so and just to kind of set the stage here, remember that permanent insurance goes through the end of your life. So it lasts as long as you do, whereas term insurance is for a specific term of time. So it's 5, 10, 20-year term. At the end of that term, the life insurance will end. The difference between the two is that the permanent insurance has an investment component to it. And therefore, the premiums are higher than term insurance. So term insurance is just insurance by itself, but it has an expiration date, whereas permanent insurance is insurance and investment, but it doesn't have an expiration date. So when you're talking about the strategy, you want something that goes through the end of your life. And the question is can we use a strategy to reduce the overall premiums? And that's what the term and perm strategy is. And so again, the first of the lump sum amount needed to replace the pension in year 1 was 322,000. But in year 20, it was 121,000. So the difference between those is 200,000. So the strategy is that you buy a 20-year term life insurance for 200,000 death benefit, and then you buy a permanent life insurance for 121,000 death benefit. What will happen is in year 20, the term life will expire, leaving only the permanent insurance, and that's the amount that you would need in that time frame. So that's exactly what you want to see happen. The benefit of this, again, is it's a much lower cost way to do this, which helps you to achieve that maximization of your pension.
Yep. And so really the question now for Bob and Julia is, how much does it cost? What do they have to pay? Well, for the permanent policy, if they were to buy the whole $322,000, it's $31.98 a year if he insured that whole amount. But if he used the combination strategy, it would be less. He'd have $11.44 annually for the term policy, $13.89 for the permanent policy, which gives him a total premium of $2,533 a year or $211 per month. So that's a savings, guys, of $665. So by using that combination strategy. So that $665 all cost gave him a raise of his pension of $654. Okay? Because we took the 865 monthly. Okay, that was the difference between that survivor cost. We multiplied it by 12, giving us the 10,380, and then subtracting out the insurance cost, that gives us the 7,847 per year, divided by 12, that's $654 per month.
Yeah,
So
that's what I call a sweet deal.
it's pretty nice. I mean, we
Yeah.
got what we wanted, we saved money, and we get to spend a little bit more money.
Mm-hmm.
So, okay. Well, enough about death. Let's talk about savings and healthcare so we can stay alive longer. Okay, so let's talk about the 401k first. So why don't you start with the 401k and then I'll go second.
Yeah, Lockheed Martin has a 401k savings plan that allows you to save money each year, tax deferred or through a Roth contribution for your retirement. And so they have some fantastic matching available to you. So they match 50% of the first 8% of your contribution. You can contribute up to $23,000 in 2024 through salary deferral. And if you're over the age of 50, you can contribute an additional $7,500. So $30,500 per year via the IRS limits. You can contribute either pre-tax, post-tax, or Roth. So that would be dependent upon your tax bracket that you're in to make that determination. And in 2026, the $7,500 catch-up contribution is required to go into the Roth if your wages are more than $145,000. There's been some changes due to the Secure Act that was passed during COVID, and that was one of the changes that came about.
Mm-hmm. So for your 401k, there's no changes to the company match. So that it's still that 50% for the first 8%. And so that means you're getting 4% of what we call free money. So you never want to leave any of that on the table. And it's just a nice graph to show you the difference of them. So Lockheed Martin, though, Josh, here's pretty important here. This is what really separates them from some other corporations. They actually allow you to contribute more than the IRS annual maximum. So they can contribute up to 40% of the base pay. So the rule is that the maximum contribution is the lesser of 100% of your compensation, or $66,000 if you're under age 50, or $73,500 if you're over age 50 in 2024. So this is really good because it allows you to invest more money into your 401k than the IRS limit. So who doesn't like to save money?
Another sweet deal.
Yes. Now you said we can do post-tax and pre-tax. So
Yeah,
tell them about the post-tax and where that goes.
Absolutely, Kelly. So one of the things that's evolved over the years is the Roth 401k. The Roth 401k allows you to put money in post-tax. And in doing so, that grows tax-free. And then when you retire, you can roll it to a Roth IRA, and it will continue to grow tax-free for you. Many people, when they started at Lockheed, they saved post-tax to not a Roth IRA. So the principal was taxed, and then the earnings was not taxed, and therefore you had basis. So when you are rolling money out of your 401k to your IRA, you will either get, in many cases, 1, 2, or 3 checks, or I should say in all cases. So for most people, they get the pre-tax contribution. For some people, they get the pre-tax and post-tax, and then for some people, they get the pre-tax, post-tax, and the Roth contribution checks. So one neat little rule that a lot of people aren't aware of is that all the money that you save post-tax can be rolled directly into your Roth IRA. So historically, and this has been a few years since they passed this rule, you'd have to go into a post-tax IRA when you rolled it out of your company once you retire. But now you can put all your post-tax and your Roth contributions into a Roth IRA when you roll it out upon retirement. So pretty neat little thing there, Kelly.
Yeah, keeping that tax-free growth is super important, especially if you've never had a Roth IRA before, because you've got that 5-year clock that starts, which we can tell y'all more about when we meet at a different time. So here's the other thing that's really important about your 401k, naming your beneficiaries. So everybody should have beneficiaries listed on your 401k, and you should make sure they are current beneficiaries on your 401k. Because what happens if you pass away while you are still at work, or even after you retire, but your 401k is still at Empower, when you die, the money in your 401k goes directly to whomever is listed on your account. Okay. So a couple good things about that. One, it avoids probate, so you don't have to worry about it, and it goes directly to your heir. The other thing though is when I say make sure it's current, sometimes people forget to change their beneficiary, and it might still be an ex-spouse on there, and whoever's listed will override whatever you really wanted in your will. So keep those updated. Make sure you have a primary person listed, so who's number one and who's your second option. If you and your spouse both die in a car crash, well, then your 401k goes to the second person line. So make sure you have primary and contingent beneficiaries listed.
Yeah, Kelly, one other thing on that is if you don't name a beneficiary, it goes to your estate and it has to be probated, which means you have to hire an attorney to transfer that out of the person's name, out of your name if you're the 401k owner, and into the beneficiary's name. So you got to pay money to an attorney. So the benefit of naming a beneficiary is you avoid probate and you avoid having to hire an attorney to get that money. So keep that in mind as you're thinking about who you want to receive the assets and how you want them to receive the assets. And we always recommend to print out your beneficiary forms and keep them on file with your other estate planning documents. That way your executor knows who's going to receive those assets.
Oh. Now there's another asset you guys have at work, and that is your company stock. So if you're like most Lockheed Martin employees, then you probably own stock in your 401k. Some may own more than others, and that's okay. So to transfer that out, there's also a strategy called the net unrealized appreciation that'll help you move your stock from your 401k into a non-qualified, just a non-IRA account. This transaction allows you to pay the tax on the transfer at a long-term capital gain rate rather than ordinary income. So that could possibly save you quite a bit depending on your tax bracket. So it's not for everyone, but you need to make sure you talk to your tax advisor before making a decision to do that. Okay, we need to switch gears and keep going. Josh, let's talk about healthcare.
All right. So a lot of Lockheed employees are not aware of their retirement healthcare benefits. So if you work for Lockheed and you're eligible, so you can determine eligibility by talking to your employee service center, and there's the phone number under bullet point 3, you would be eligible to continue your health insurance once you leave Lockheed. And for many Lockheed employees, this is actually a very good deal. So if you're thinking about how you're going to pay for health insurance pre-Medicare, pre-age 65, Lockheed has a solution for that. And remember, because of the Affordable Care Act, there's no more pre-existing conditions. So anybody can qualify for health insurance now. Of course, the cost is not cheap, as you may imagine. Health insurance is not cheap for anybody these days. But it's something to remember as you're thinking about retiring, is to make sure you check out the Lockheed benefits that are available to you. And I'm talking more than just the coverage once you leave for a limited time frame. We're talking about extended coverage for healthcare.
Yeah, to take you through retirement and until you guys get to Medicare. So you also have the ability to supplement your Medicare through VIA benefits. So you become eligible for this when you're 65. That's when you've probably seen commercials, heard them on the radio. Now is open season time. Start looking at your Medicare supplements, your Advantage plans, things of that sort. So you start shopping and enrolling for your supplemental plan about 3 months before your 65th birthday. And so Lockheed Martin may be even able to provide you a subsidy to help offset some of this cost. Okay, but you have to be enrolled in Medicare Part A and B to get that subsidy, and you must enroll through the VIA benefits or have TRICARE for life to be eligible for the subsidy. So if you choose to enroll later than when you first turn 65, Depending on your situation, maybe you're still at work, you're covered by a spouse, you could still be eligible for the company subsidy benefit. I am getting tongue twisted this afternoon.
Yeah, and Kelly, that's a really neat benefit for you guys. That's a lot of our clients take advantage of that. So be sure and mark that down to, if you're not quite there yet, to remember to do that, because that subsidy brings the cost down for you. And they've got a nice platform for which they offer that through.
You can also save money and help in cost with your health savings account. Tell them about that.
You know, this is one of the most underutilized tools that are out there, but it's one of the coolest ways to save money. It's called a health savings account, not to be confused with this flexible spending account. So health savings account is used, or you're eligible for this, when you have a high deductible health insurance plan that's HSA eligible. So to be able to use this, you have to have the plan first that's HSA eligible. But if you elect that plan, then you can save money to the HSA. And the amount in 2024 is $4,150 for single and $8,300 for family. If you're over the age of 55, there's a $1,000 per year catch-up contribution. And the benefit of this is that you can use it tax-free when you use it for medical expenses. So the other advantage to this is that not only you can use it for you don't pay any income tax on it, you also don't pay FICA taxes. So FICA taxes are 7.65% of your pay. That's for Social Security and Medicare. So HSAs, when done through or were contributed through your employer, avoids paying that FICA tax and the income tax. And then once you retire, you don't lose the money. So it's your money. You can take it with you. You can invest the money. And many people grow a large balance and invest that money to be used for retirement. And so one of the key benefits of this tool as well is that once you turn age 65, you can use it for non-medical related expenses, but you pay tax on that money. You're just not penalized, and it's a 10% penalty when you use this money for non-medical related expenses before the age of 65. After 65, that penalty goes away. One key thing to take note of is once you enroll in Medicare, you're no longer eligible to use an HSA plan. So keep that in mind. A lot of people make the mistake of continuing to contribute to it, but you do have to stop once you enroll in Medicare. So again, folks, a great way to save for medical in retirement, but even beyond medical, you can use it for other expenses without penalty. You just have to pay the tax. And it has a nice limit amount that you can put in there. We always recommend clients to max that out every year.
You know what? Lockheed does really have some great options on their healthcare. They also have really good options on the other insurance they have as well. Here's one thing I found was of great benefit to a number of employees. Things happen in life. You may not be insurable. Something in your family might happen. But the insurance that's there, whether that's the term insurance you have in multiples, your universal life, a special accident, if you have insurance on your children or your spouse, that's the dependent optional term insurance. Those are all portable, and you can take them into retirement with you without any insurability requirements if you're keeping the same amounts. Same thing with disability, and if you were one of the ones that chose long-term care, you can keep that too. Now, if you want more insurance than what you currently have going into retirement, during open season, if you still have time, you want to up that so we can transfer, because without insurability, that's what you have to have, what you have now and what you take into retirement with you. But these are wonderful options for people, because sometimes, I mean, if you're retiring and you're already over 65 or in your 70s, it can be challenging to get it, or it can just be too expensive. So this is really, really good. Okay, well, guys, I hope you have liked that good news on the insurance, because we are now going to go over the top 10 retirement mistakes and hopefully help you avoid making any of these mistakes. So number one, not taking advantage of the full 401k match, that 50% to 8%. Josh?
Not taking vacation and then retiring. So actually utilizing your vacation pay to maximize what you receive.
You know what some people do? they will start decreasing their time at work. They'll do 1 day a week to start using that down. So they're working 4 days, then 3 days, then 2. That's really a good help in transitioning into getting used to not going to work every day.
Yeah.
So, okay, and not using that pension maximization strategy you showed us, that was really awesome. Save us lots of money there.
Not
Okay.
using post-tax portion of your 401k to save more money. So again, you can save up to 40% of your income to your 401k at Lockheed. That's a great way to catch up if you haven't been able to save because you've had kids that you've had on the payroll for many years. That's a great way to catch up to help you to retire with your nest egg that you need.
Yeah. Also, not rolling your post-tax portion of your 401k into your Roth IRA. Some people accidentally put it in their traditional. No, no, no. Don't do that.
And then not naming a beneficiary on your 401k. Folks, we've seen lots of people over the years make this mistake, and you don't want to pay an attorney. So make sure you name a beneficiary.
Also, and not taking advantage of that net unrealized appreciation of their stock.
Yeah, unique strategy to help save money on taxes. And then not utilizing Lockheed Martin Healthcare and Medicare benefits. Again, a fantastic benefit for you guys.
Yep. And not contributing the maximum to the health savings account.
Getting that good tax-free benefit. And then number 10, not utilizing Lockheed Martin Guaranteed Universal Life Insurance. That's a great tool when we look at pension maximization. Again, a life insurance you can take with you that's permanent.
And a special bonus for you guys, not using Josh and I here at Strittmatter Wealth to plan for your retirement. Okay. Don't make that mistake. So let's tell them what they need to do next.
Absolutely. So what we always recommend that you do is take action. So you have some momentum right now. What we recommend is to begin to gather your information, write down your objectives and questions based on what you've learned in this class, and then request a complimentary consultation to begin to look at your overall retirement plan and your pension maximization strategy. We've got a unique offering for you today.
Well, why don't we tell them what we do first?
Absolutely. That's a good idea.
So, guys, we do a lot. We are comprehensive financial planners, which focus on planning for your future, includes asset management and estate planning. But inside there, we also do the retirement planning, the tax planning. We're all certified financial planners. We have a very simple flat fee structure when it comes to our overall planning. And then on our investment management side of the house, we are an independent registered investment advisory firm, which means we don't have any proprietary products, no affiliations with any particular broker dealer or management or so. So that means there's no conflicts of interest. We have institutional style investing. And again, we keep it simple. We have a flat percentage tiered fee schedule that's based on your asset levels. For the insurance side of the house, we also have our own independent insurance agency. And that's important. When people come to us and they need life insurance, long-term care, disability, we're able to fill those gaps for them as well. But you can request a discovery meeting to learn a little bit more. Now, before we tell you our special offer, one last thing before that too. We also have some other great informational items for you. So let's see, we've got our blog. So on our website, you can go to strittmatterwealth.com and you can see the Lockheed Martin specific blog. We have another blog as well, but this one's specific to all of you guys. We do have various newsletters, e-newsletters that you can sign up for. One is a weekly market update specifically from Josh. He is our Chief Investment Officer. We have a monthly one on retirement ideas, lifestyle, and events. And of course, we teach other classes at local universities. We're at UTA, at University of Texas in Arlington, the Tarleton Fort Worth campus, TCC, various campuses, and out in Weatherford. We teach how to get ready for retirement, Social Security, wills, trust, and estate planning, and even how to invest in real estate. But I know you've been waiting for the special offer. So, Josh?
I'm excited to tell them about this, Kelly. So we offer a complimentary 401k analysis report. And so what we do for you folks is we review your existing portfolios for ways to improve performance. We review your investment risk to minimize unnecessary losses. you'll receive a personal recommendation on how to invest to maximize your growth over time. This is valued at $500. And so when we host these webinars, we offer this for a limited time. It expires today at 5 p.m.
Meaning it's free.
It's free until 5.
Okay. But there's one more.
There's
wait.
more. If you're more interested in the pension maximization that we talked about today, we offer a complimentary pension maximization analysis report. And so the benefits of this, it helps you to determine if this strategy will be right for you. So as Kelly mentioned earlier, it may not be right for everybody because everybody may not be insurable. So you've got to determine if you're insurable. It determines the amount and cost of the insurance needed. We put that plan in place and make sure that you're ready to go for when you retire. Here again, this report is valued at $500. It's free until 5 p.m. today.
Yes, so if y'all are interested and you would like to either have a conversation to talk about anything that we've discussed today or anything else, you can let us know. If you want one of these free reports, I'll leave this up on the screen. You can scan one of these QR codes, schedule one, don't do both, just one. And then we can meet up with you via Zoom, Teams, in person, whatever works best for you.
And keep in mind, folks, this usually books up pretty quick. So, and we're getting near the end of the year. So if you like this, we encourage you to book it today.
Mm-hmm.
That way you can get the full benefit of it. Also, we want to thank you for attending our presentation. We're going to send out a copy of this to you today, and you're welcome to send this on to anybody you think that would benefit from it. We didn't get any questions as we went through today's presentation. You're welcome to type a question into the chat feature if you'd like, and we're happy to stick around and answer any questions. We'll stick around for just a little while and answer your questions, but be sure and request your free reports. And Kelly, you got anything else?
No, I was going to mention the chat section. This is usually the time when people start asking questions. So don't hesitate when you ask a question. Only Josh and I can see it, nobody else. So it will remain just visible to us, and we'll give you an answer as best as we can. So let's see.
While we're waiting on any questions, Kelly, what do you think is the most important thing for a Lockheed retiree to do to prepare for retirement?
Oh, goodness. Let's see. In my 23 years of experience, what I have seen the most is usually the insurance side of the house. You know, how much do they need? How much do they want? What can they afford? Are they ready and set up? Things of that sort.
Yeah.
And the 401k is the fun piece that everybody wants to talk about, but oftentimes there's the more important things that need to be talked about.
Yep, and we got a question in.
Okay.
The question is, are we affiliated with Lockheed Martin or just direct marketing to Lockheed Martin? We are not affiliated with Lockheed Martin. We've just worked with lots of Lockheed Martin employees over the years. So we've got a pretty big client base of Lockheed Martin employees. We know all the benefits inside and out, and so we market directly to Lockheed Martin employees.
Mm-hmm.
Thanks.
Now there is a program at Lockheed where they bring people in to talk, and so we have been invited from them as well to be a guest host in the plant, the Fort Worth plant.
Yeah.
Yep.
Another question is, can you provide references? Actually, what you can do now is you can go on to our Google reviews. We can obviously provide references as well, but the Google reviews, we've got over 105 star. You can go to the Better Business Bureau. We have close to 105 star in the Better Business Bureau, and then also on our Facebook. Another question is, what percentage of Lockheed Martin retirees pick single life policy? That's a great question. There's more to what we present to you today. So when we do a financial plan for clients, we talk about other strategies around the pension. And so here's an idea of kind of a thought process there is that for a lot of retirees, they've saved a good amount of money that would take care of their spouse. And so sometimes we talk about, we'll do an analysis to determine if they even need life insurance. If they just chose the single life payout and they died in day 2, do they still need life insurance because they have so much money saved up for retirement that would take care of their spouse? Disadvantage of that is of course, you would have lost all of that money in day 2. So, there's pros and cons in terms of how you view this, but we try to educate you on those different pros and cons and help you to make an informed decision on which direction you want to go. But we have plenty of clients that take the single life payout, specifically because that's how the pension maximization works, is you take the single life payout.
Those are great questions. Okay.
So while we wait, I'll tell you my thing that I think is most important for Lockheed employees to think about. And that is to think about what you're going to retire to. So a lot of Lockheed people work a lot of long hours, so 60 plus hours a week. And so their bodies are used to going 90 miles per hour. And then they come to a complete stop. And for many people, that's very hard on their bodies. So, and for some people, they unfortunately they pass away because they weren't prepared. So we recommend having a plan for what you want to do in retirement. So are you going to volunteer? Are you going to work part-time? Are you going to spend more time with family? But plan that out in advance before you retire. Be ready for when you retire. That way you don't feel a sense of loss, a loss of purpose. A lot of people find purpose in their work. So finding your next purpose is what you should all be focusing on when you're preparing for retirement. And again, thinking of that in advance.
That's
All
a
right,
big
Kelly.
deal.
I don't see any more questions. So
Okay.
hopefully that was helpful to all of you. We hope you have a great rest of your week and a great holiday if we don't talk to you. And thank you so much for your time.
Thank you. Have a wonderful one. Bye-bye.